Are you a parent who wants to give your child a financial head start? Well, you are in the right place. Welcome to Beyond Piggy Banks. I'm George, and in each episode we explore simple, practical ways to shape your child's financial future. And the best part, you don't need a financial degree, and you don't need a lot of money to begin. The earlier you act, the bigger their advantage becomes. Let's build their future. In the last episode, we went to the market. We looked at the ingredients: equities, bonds, real estate, commodities, alternatives. We understood what each one does, what it costs in risk, and what it delivers in return. We understood that you will not be buying these ingredients directly. You will be buying a fund that holds them for you. But knowing your ingredients is not enough. You also need a way to bring them home. That is an ETF. It is not the ingredient. It is not the recipe. It's a pre-arranged basket, already assembled, already diversified, ready to carry home at the lowest possible cost. One basket, hundreds of ingredients inside, one price, one purchase. Today, we open the basket and look inside. What is an ETF? ETF stands for Exchange Traded Fund. Break that down and it tells you almost everything. It's a fund, meaning it holds a collection of assets, and it's exchange traded, meaning you can buy and sell it on a stock exchange, just like a share in a single company. When you buy one share of an ETF, you are instantly buying a small piece of everything inside it. That could be 500 companies, it could be thousands of government bonds, it could be gold, it could be real estate, or a mix of assets across multiple countries and currencies. One purchase, one price, instant diversification. This is the power of the ETF. It takes the complexity of building a diversified portfolio and collapses it into a single, transparent, low-cost instrument. A quick reminder on what is an index. Remember, an index is just a measurement, a list of assets grouped together to represent a market. The S&P 500, the MSCI World, it tells you how a market is doing. The ETF is the basket that follows it. Now, not all baskets are the same, and the distinction matters. The first type tracks an index. This is the basket we have been talking about throughout this series. A fixed arrangement. It holds exactly what the index says, in exactly the proportions the index dictates. No manager making decisions, no active trading. Just follow the index, keep costs low, let the market work. The second type does not track an index. These are actively managed ETFs. A fund manager decides what goes inside, what to buy, what to sell, when to move. The basket trades on an exchange just like a passive ETF, but inside, a chef is making decisions. And as we discussed in episode 6, that chef charges for their time, whether the meal turns out well or not. For the system we are building, the index tracking basket is the one we prefer. Fixed arrangement, low cost, no surprises. Do you remember in episode 2 when we said you could own the entire track instead of just one horse? Well, someone built a basket for every track, every horse, every race, in every country, on every continent. Gold, there is a basket. Clean energy, there is a basket. Japanese small companies, there is a basket. Your neighbor's crazy idea about water scarcity, there is probably a basket for that too. Global equities, thousands of companies across dozens of countries in one purchase. Government bonds from stable economies, emerging markets like India, Brazil, South Korea, growing fast and carrying more risk. Developed markets, steady, established, reliable. Entire regions, individual countries, specific industries, specific themes. If you thought of it, it probably exists. The question is not whether the right basket exists. The question is how to choose the right one for your child's portfolio. And we will get there. ETFs are created and managed by asset management companies. Think of them as the companies that prearrange the baskets. 3 names are truly global. You will encounter them on virtually every exchange in every market, wherever you are in the world. We have Vanguard, founded by Jack Bogle, the man we met in episode 6. Vanguard is owned by its fund investors, not by external shareholders. Its incentives are aligned with yours, known for exceptionally low costs. Then we have iShares, which are the world's largest ETF provider and owned by BlackRock. They offer an enormous range of baskets covering virtually every market and asset class imaginable. SPDR, which is pronounced Spider, managed by State Street Global Advisors, home of some of the oldest and most traded ETFs in the world. Beyond these 3, regional manufacturers exist for specific markets. In Europe, Amundi and Xtrackers are well established. In Australia, BetaShares is the largest locally owned provider. In Asia, Nikko Asset Management in Japan and Mirai Asset in South Korea are widely recognized names. Wherever you are, the global 3 will always be available. The regional names become relevant as you explore specific markets closer to home. These are not recommendations, they are a starting point. When you begin evaluating funds, you will encounter these names repeatedly. So, the baskets exist, the manufacturers are known. Now, how do we evaluate one? There are 5 things or characteristics that are relevant for our objective. The first one is TER. So TER stands for Total Expense Ratio. It is the annual cost of holding the basket, expressed as a percentage of your investments. We covered this in episode 5. A difference of 1% per year sounds small. Over 10 or more years, it is not. It is tens of thousands quietly living your child's future. Always check the TER. For broad index tracking ETFs, a TER below 0.20% is achievable. Above 0.5%, ask why. The cost of the basket should never eat the ingredients. Next is liquidity. Liquidity is how easily you can buy or sell the basket at a fair price. A highly liquid basket trades millions of units every day. You can enter or exit instantly without moving the price. A low liquidity basket may have a wide gap between the buying and selling price, costing you more than you realize on every transaction. As a rule, larger, more established baskets from major manufacturers are almost always more liquid. Look at the average daily trading volume as your guide. Number 3, AUM, translating Assets Under Management. It's the total value of money held inside the basket. A larger AUM means a more established, more liquid fund. A very small basket may be discontinued by the manufacturer if it fails to attract enough investors, forcing you to sell at a potentially inconvenient time. As a general guide, look for ETFs with at least 100 million in assets under management. Larger is generally safer. Number 4, accumulating versus distributing. This is one of the most practically important choices you will make. A distributing basket pays out dividends and income to you regularly. It can be monthly, quarterly, or annually. You receive cash. That cash may be subject to tax in the year you receive it. An accumulated basket does not pay out dividends. Instead, it reinvests them automatically back into the basket. Your money compounds without interruption. No cash arrives in your account, and in many jurisdictions, no immediate tax event is triggered. For a long-term portfolio built for your child, accumulating is almost always the better choice. The compounding effect of reinvested dividends over 10 or 20 years is significant, and the tax efficiency is a meaningful advantage. We'll go deeper on the tax implications in a later episode. For now, know the difference and lean toward accumulating. Last one, base currency. Every basket has a base currency, which is basically the currency in which the fund is valued and which its underlying assets are priced. This is different from the currency in which the basket trades on your exchange. You might buy a basket listed in euros on an European exchange, but its base currency is US dollars, because the assets inside are priced in dollars. This matters. Currency movements affect your real returns. If the dollar rises against the euro, your basket gains value in euro terms, even if the underlying assets did not move. If the dollar weakens, the opposite happens. This is currency risk, and it's one of the most underestimated forces in the long-term investing. Understanding it and knowing how to manage it, it's the subject of our next episode. For now, always check the base currency of any basket you are considering. Know what currency exposure you are carrying. A quick word on past performance. So every ETF page you will visit will show you a performance chart. 1 year, 3 years, 5 years, 10 years. Read it, understand it, and then remember this. Past performance does not indicate future performance. A basket that returned 15% last year may return minus 10% next year. Choosing or avoiding an ETF based on recent returns is one of the most common and most costly mistakes investors make. It's the follower from episode 4, dressed up as research. What past performance can tell you is something more modest and more useful. If a basket consistently delivers less than its own benchmark indexed over multiple years, that is a sign worth investigating. High costs, poor construction, tracking error. A red flag, not a reason to buy. Use past performance to identify problems, not to chase winners. The basket is now ready. You now understand what an ETF is, how it works, what universe of options exist, who manufactures them, and what to look for before you choose one. But there is one factor we introduced today that deserves a full conversation of its own. Currency. Every investment you make exists in a currency. And when your currency and the basket-based currency are different, the exchange rate becomes part of your return. Sometimes it works in your favor, sometimes it works against you. And over 10 or 20 years, the differences can be significant. In the next episode, we talk about currency risk, what it is, how it affects our portfolio, and how to protect against it. I'm George, and I'm here because your child deserves the advantage we never had. We are done hoping for the best, we are building it. Subscribe to Beyond Piggy Banks on Spotify, Apple Podcasts, or wherever you listen. The clock is ticking, let's get to work.